The fundamental error committed by the vast majority of speculators is the belief that trading success hinges solely upon predicting the movement of prices. They dedicate countless hours to studying charts, analyzing news reports, and perfecting technical indicators, believing the market is a puzzle that, once solved, yields immediate riches. This approach erroneously places 90% of the focus on external forces, what the market is doing, and only 10% on internal forces, which define the speculator's ability to manage themselves. True mastery in speculation, a truth codified by figures like Jesse Livermore, is not about technical brilliance, but about achieving a psychological edge that must precede any technical advantage. Before we delve deeper into the specific pillars of self-mastery, please take a moment to engage with the channel. Subscribe now and leave a quick comment below, even if it is just a single word like discipline. This simple action greatly helps the algorithm recommend this video to more people and shows me that this kind of content truly matters and is worth creating. Furthermore, remember to return to this channel during challenging times, especially when trading becomes difficult and your confidence starts to waver. The common mistake is focusing exclusively on the what and the where of the market, ignoring the who behind the order button. The question that must be answered before any financial capital is committed to the market is therefore entirely psychological, demanding rigorous self-inventory. It is not, where is the market going next, but rather, what is my personal capacity for pain, patience, and objective action? This singular question forces the speculator to treat trading as a psychological inventory before ever performing a financial one. If the speculator cannot accurately gauge their own temperament, they are merely gambling against their own psychological limitations, ensuring eventual failure regardless of the quality of their system. This self-assessment is the ultimate form of risk management because human emotion, not market volatility, is the most destructive force in the speculative arena. Every master speculator understood that the market is merely the mirror reflecting the speculator's own character flaws and strengths back at them. The first essential pillar of self-assessment involves scrutinizing the capacity for patience, which is often referred to as the waiting game. The speculator must determine if they possess the internal fortitude to wait for the precise moment of confirmation dictated by their established system. This test is crucial because the impulse of impatience often manifests as a premature entry, forcing the speculator to accept unnecessary risk or a suboptimal position. The difference between being intellectually correct about an impending trend and being emotionally capable of waiting for the low-risk entry point is often the difference between profit and loss. The impatient speculator often chases the move, buying high simply because they fear missing out on the initial momentum. True speculative discipline understands that patience dictates waiting for the pullback or the definitive signal, thereby guaranteeing a more favorable risk-to-reward ratio. This necessity for idleness is perhaps the most difficult lesson for active minds to accept, yet it is profoundly necessary for success. A successful speculator often spends the vast majority of their time doing absolutely nothing, waiting for the clear, high-probability opportunity to present itself. Accepting that inactivity is frequently the best and most profitable action fundamentally shifts the speculative mindset away from constant need for engagement. Pillar 2 requires the speculator to assess their handling of loss, directly testing their pain threshold. This inquiry seeks to determine the speculator's emotional reaction to the inevitable series of consecutive losing trades that characterize market participation. How large of a drawdown, measured both in monetary terms and psychological stress, will the speculator accept before panic, desperation, or the destructive urge of revenge trading begins to take hold? A failure to rigorously predefine this threshold turns every losing trade into a potential bomb waiting to detonate the entire trading account. The most lethal psychological trap in this domain is the insidious influence of hope, which must be ruthlessly eliminated from the speculator's decision matrix. Hope is the internal conflict that allows a speculator to hold a declining position past the designated objective stop-loss point simply because they hope the market will reverse. Allowing hope to dictate action turns a manageable, small, predefined loss into a catastrophic, account-threatening one. The specific method for handling loss involves predefining the maximum acceptable monetary and psychological pain threshold before the trade is ever entered. Rigorous adherence to this predefined threshold is non-negotiable, demanding that the speculator execute the stop-loss order the moment the pain arrives, without hesitation or internal negotiation. A small loss is merely the cost of doing business, a necessary expense incurred while waiting for the larger, profitable opportunity to materialize. The speculator must accept that every system, no matter how robust, will produce losing streaks, and success depends entirely on how those streaks are emotionally and financially managed. The market does not care about the speculator's hopes or feelings. It only respects decisive, objective action based on established rules. Pillar 3 focuses on the control of greed, which primarily manifests as the mistake of selling too early. The test here is whether the speculator can allow a profitable trade to run its full course, adhering to the profit target or trailing stop methodology, or whether they will succumb to the fear of losing paper profits. Many speculators find it easier to take a small loss than to allow a large profit to ride through necessary market volatility. This reveals a fundamental psychological trap. Speculators often fear losing what they currently possess, the paper profit, more than they fear losing what they do not yet possess, the potential future profit. This fear of profit erosion leads to premature selling, locking in small gains that fail to compensate for the string of necessary small losses. The successful speculator understands that large profits are generated by patiently holding strong positions through minor pullbacks and noise. Understanding when to take profit often requires objective analysis of market structure rather than relying on internal emotional impulses. If your current struggle involves determining whether the market is truly accumulating for a move up or distributing for a move down, you need a robust framework. We have established a dedicated channel devoted to the deep study of Richard Wyckoff's methodology, which provides the objective discipline required to counteract impulsive selling or buying. This resource offers comprehensive analysis of accumulation and distribution cycles, allowing the speculator to identify the structural footprints of large operators. Learn to identify these crucial market phases by following the link provided in the description, ensuring your profit-taking decisions are based on structure, not fleeting fear. The instructional insight here is critical. The market owes the speculator absolutely nothing once a position is established. Profit is secured only by adhering rigorously to the trailing stop or scale-out plan, not by succumbing to the impulse to lock in a small gain out of fear. Greed, ironically, causes the speculator to settle for too little, while discipline demands patience to capture the full potential of the move. The objective plan must always dictate the exit strategy, overriding the short-term emotional desire to secure the immediate cash. The speculator must train their mind to view the volatility within a profitable trade as normal noise, rather than as a signal for immediate panic and exit. Pillar 4 requires a practical assessment of alignment between the chosen methods and the speculator's personal resources. The fundamental test is whether the speculator's chosen trading style, be it aggressive day trading, moderate swing trading, or long-term position holding, realistically matches their available capital structure, time commitment, and personal constitution. A high-frequency, aggressive day trading strategy demands significant capital to absorb volatility, immense focus, and a high stress tolerance, which few individuals genuinely possess. Attempting to implement such a demanding strategy with insufficient capital or a naturally low stress tolerance guarantees burnout and inevitable failure. The mismatch failure occurs when a speculator, perhaps inspired by unrealistic success stories, adopts a strategy that conflicts directly with their life circumstances. For example, a person with a full-time job and family commitments cannot realistically execute a short-term scalping strategy that requires constant attention. Such a conflict creates forced decisions, emotional stress, and deviations from the plan, which are the hallmarks of speculative failure. The successful speculator chooses a methodology that harmonizes with their financial cushion, available time, and innate personality traits. This alignment ensures that the system can be executed calmly and objectively, without the pressure of external life demands interfering with the market decisions. Once the speculator has honestly answered these 4 pillars of self-assessment, they must implement a mandatory system for monitoring and correcting internal errors. The first step in this implementation phase is the mandatory documentation provided by the Comprehensive Trading Journal. This journal must record far more than just the entry and exit price of the trade, which only captures the market's behavior. Crucially, the journal must record the precise emotional state and reasoning for every decision made while under market pressure. The speculator should note down feelings of excitement, fear, impatience, or frustration immediately before and after executing a trade. This documentation is vital because the primary focus of the journal shifts from market analysis to the behavioral analysis of the speculator. The goal is to identify and isolate recurring behavioral errors, such as always doubling down on a losing position or consistently selling a winning position on the very first minor pullback. These recurring patterns of self-sabotage are the true enemies of the speculator, hidden deep within their own psychology. By diligently tracking these internal states, the speculator creates a map of their own behavioral pathology, which is required for effective correction. The journal serves as an objective external observer, forcing the emotional speculator to confront the reality of their impulsive actions. Without this documentation, the speculator is doomed to repeat the same self-destructive mistakes, attributing them to bad luck or market manipulation rather than personal failure. A journal that ignores the emotional component is merely a ledger. A true trading journal is a psychological inventory. The second implementation step is the rigorous post-mortem analysis of self-sabotage, treating every failure not as a financial disaster, but as a crucial data point in understanding one's own pathology. The analysis must be cold, objective, and unforgiving, focusing specifically on identifying the exact moment the speculator deviated from the written trading plan. Was the deviation caused by an external factor, such as an unexpected news event that invalidated the setup? Or was it internal, stemming from an emotional breakdown like panic or greed? If the deviation was internal, the speculator must pinpoint the specific psychological trigger that caused the plan to be abandoned. Was it the fear of missing out, the exhaustion from monitoring, or the overwhelming desire to recover a previous loss? This forensic analysis allows the speculator to isolate the internal weakness and create a specific rule designed to counteract that weakness in the future. Trading success is achieved not by eliminating losses, which is impossible, but by systematically eliminating self-inflicted behavioral errors. The speculator who successfully completes this internal inventory understands that the market only rewards those who have first mastered themselves. Self-knowledge, manifested through rigorous documentation and adherence to a personal risk threshold, is the ultimate and most powerful form of risk management available. The greatest edge a speculator can possess is not proprietary information or a complex algorithm, but an unwavering, disciplined mind capable of executing a simple plan under extreme pressure. This discipline ensures that the speculator operates consistently in the high probability zones, avoiding the emotional traps that ensnare the majority of participants. The speculator who cannot honestly and objectively answer the fundamental question about their own patience, pain tolerance, and discipline is simply speculating on their own inevitable failure. They are operating without a psychological stop-loss, making them vulnerable to the market's slightest tremor. Trading success is fundamentally the result of applying a disciplined mind to a disciplined method, a process that begins and ends with self-mastery. This internal control is the prerequisite, the foundation upon which all enduring speculative fortunes are built. The foundation of speculative success is self-knowledge, a truth acknowledged by every successful trader throughout history. The experiences of master speculators provide a direct roadmap for modern practitioners facing identical psychological battles. For those seeking the definitive manual on the psychology and strategy of Jesse Livermore, look no further than the new edition of Edwin Lefebvre's classic, Reminiscences of a Stock Operator. This edition offers a profound analysis of Livermore's journey, complete with unique commentaries and chapter-by-chapter breakdowns that transform his historical experience into practical modern lessons. If you are serious about treating speculation as a serious business, this book is required reading, and you can find the link to secure your copy in the description below. The true speculator understands that the battle is waged not against the market, but against the inherent weaknesses of human nature. The market merely provides the terrain. The victory belongs to the disciplined commander of self. Answering the fundamental question correctly ensures that the speculator enters the arena prepared, not just with capital, but with the necessary mental armor to endure and profit. This rigorous self-inventory transforms the speculator from a gambler into a calculated, objective operator, ready to exploit the emotional mistakes of the undisciplined crowd.